Entering the world of real estate investing opens up different opportunities, but let's be honest, it's not all sunshine and profit. Investing in real estate involves finding the right balance between risk and reward, especially in the private equity domain where tangible properties offer a sense of security. Are you ready to take the risk? Hello, aspiring homeowners and seasoned investors. Step into the world of Las Vegas and Henderson with me. I am Phan, your host for Long's Real Estate Podcast, where we'll dive deep into all things real estate. Let's unravel the secrets to mitigate the risk and maximize the rewards in the world of real estate investments. Investing in real estate involves finding the right balance between risk and reward, particularly in private equity markets where tangible properties provide security. Yet, the intricacy of real estate investing require a thorough grasp of the involved risk. At Origin, we know how crucial it is to measure risk, match them with investor goals, and create plans to reduce them. In this podcast episode, we'll explore the various risks in real estate investing, from market changes to property-specific issues. We'll show how our strategies can guide investors through these challenges. We'll look into tools and frameworks for understanding risk tolerance, ensuring your real estate investment matches your financial goals. Here are the top 5 risk factors investors should consider when evaluating any private real estate investment. The first one is structural risk. Structural risk in real estate investment is about how the financial setup affects who gets paid first or last when things go south, rather than the physical condition of the property. For instance, imagine a scenario where different stakeholders like sponsors, lenders, and equity investors are involved. Debt structures decides the order of payouts during liquidation, putting equity investors at the most vulnerable end, while senior secured loans get priority. To prevent this, thoroughly understand the financial agreements governing investments. Look beyond the property itself and grasp the intricate rules that decide who gets what in tough times. Here's a simple explanation. If you invest in a property with debt, like a mortgage, and the property doesn't generate enough income to cover the debt payments, the lender might get paid first from any proceeds of selling the property, leaving the equity investors with potentially nothing. So what should you do? Before investing, carefully review and understand the financial agreements, such as debt structures or profit distributions, to know where you stand in case of financial strain or liquidation. The next one is general market risk. General market risk is the danger of changes in the economy, like inflation or interest rate swings, and these can affect real estate investments. You can't control market ups and downs, but smart investors protect themselves by diversification. That means investing in different types of properties or in different places to balance out the market's unpredictability. Consider a scenario where you allocate all your financial resources to real estate in a specific region, and unforeseen economic downturns occur in that area. Your investments could be adversely affected as they are closely linked to the economic condition of that singular location. It's advisable to diversify your investments by spreading them across various property types or locations. Additionally, consulting with experienced market experts is crucial. Their insight can assist you in developing a well-informed strategy that takes into account current market conditions, providing valuable guidance, especially in periods of uncertainty. Another associated risk in real estate investment is financial risk. Financial risk is specifically tied to the amount of debt utilized for property acquisition. When interest rates rise, the repayment of loans becomes more expensive, impacting the overall profitability of the investment. To manage this risk, carefully consider your investment terms, the amount of capital you are comfortable investing, and the duration of the investment. It is essential to have a clear understanding of the expected profit compared to these factors. So, be mindful of the amount of debt you take on. Make sure you're comfortable with the terms and how they might change. Also consider the level of risk you're okay with. For a risk taker, investing in a riskier property might mean higher potential returns, like buying a property in a less popular area and improving it for higher profits. But this needs a good understanding of the market and a calculated willingness to take risk. The key is finding the right balance and making informed choices based on your risk tolerance and property dynamics. There is also what we call asset level risk. This means different types of properties come with different risks and rewards. For example, apartments are often seen as safe because people always need a place to live, but they might not make as much profit. On the other hand, hotels rely on tourism and can make more money, but they're riskier because they depend on travel trends. Imagine investing in an apartment complex where you're likely to have steady tenants but might not make as much profit compared to investing in a hotel, which could make more money but might suffer during economic downturns. To prevent this risk, understand the pros and cons of different property types. Think about how much risk you're comfortable with and what kind of returns you're looking for. It's about finding a balance between safety and potential profit that matches your goals and comfort level. Lastly, location risk. In real estate, it's all about where a property is situated. It's not just the address, it's the whole neighborhood, surrounding, and community vibes. For example, think about whether it's in a busy city area or a quieter suburb, or if it's in an area that's growing or changing. Things like schools, stores, and safety can affect how much the property is worth and how much people want to live or do business there. Say you buy a house in a safe, growing neighborhood with good schools nearby. It might be worth more and attract more buyers than a similar house in an area with higher crime rates and fewer amenities. Here's a valuable tip. Prior to making any investment, conduct thorough research on the prospective location. Consider crucial factors such as safety, amenities, and the overall atmosphere of the area. The success of your investment can significantly hinge on the location of your property. Therefore, making a well-informed decision about your location is essential for maximizing profits. As we talk deeper into the risk of real estate investment, let's explore some of the burning questions that often crop up in the minds of eager investors. These frequently asked questions shed light on crucial aspects of risk management in this dynamic landscape. The first frequently asked question is, how can I assess and mitigate the risk of a bad tenant or vacancy? The tenant dilemma, a common concern for many investors. Mitigating this risk begins with rigorous tenant screening, background checks, credit history reviews, and previous rental references can provide valuable insight into a potential tenant's reliability. Additionally, having a robust lease agreement outlining terms, policies, and consequences can offer protection. I will give a quick and simple explanation. Consider an investor who hastily leases out a property without proper venting. The tenant defaults on the rent and causes significant damage, resulting in a prolonged vacancy period and financial losses. That's why a thorough screening process and clear lease agreements can significantly reduce the risk of bad tenants or vacancies. Consider working with property management professionals who specialize in tenant selection and handling to ensure a smoother rental experience. The second question is, how do I protect my investment from natural disasters or unforeseen damages? Nature's unpredictability is indeed a concern. To safeguard against natural disaster or unforeseen damages, consider insurance coverage tailored to protect your investment property. Look into comprehensive policies that cover a range of potential risks, including fire, floods, earthquakes, or other environment hazards specific to your property's location. Imagine an investor who overlooks the necessity of flood insurance for a property located in a flood zone, and suddenly a flood damages his home extensively, leading to high-cost repair that weren't accounted for. Investing in appropriate insurance coverage is very important. Consult with insurance experts to understand the specific risks associated with your property's location and ensure adequate coverage against natural disasters or unexpected damages. In conclusion, navigating the risk in real estate investment involves proactive measures and meticulous planning. From tenant screening to insurance coverage, every step taken to mitigate risk contributes to a more secure investment journey. Stay vigilant, employ sound strategies, and always factor in potential risks to safeguard your real estate ventures. Tackle real estate investment risk with me. Like what we mentioned earlier, onset of this podcast. Real estate investing is thrilling, but it's not without its risk. Whether you're a seasoned investor or just starting out, understanding and managing these risks is key. But fear not, you don't have to navigate this journey alone. Imagine having a seasoned professional by your side, someone who knows the ins and outs of the real estate world. Seeking advice from a professional, realtor, or expert can be a game changer in your real estate investment strategies. So why talk about these risks? Well, it's about gaining perspective. By discussing potential pitfalls, you're better equipped to make informed decisions. Whether it's market volatility, financial risk, or location concerns, addressing these issues give you a clearer path to success. But hey, we're here for you. If you have questions or uncertainties about real estate investment risk, don't hesitate to reach out, whether it's through our platform or your trusted realtor. Getting answers can provide the clarity you need to move forward confidently. Remember, an advantage of discussing these risks is immense. It's about empowering yourself with knowledge and insights that could potentially save you from costly mistakes. So let's tackle these risks together. Seek guidance, ask questions, and delve into discussions about real estate investment risk. Your journey to successful investment starts with understanding and managing these challenges. So what is the bottom line? Real estate investors, regardless of the property type, should ask about risk and get clear answers. Don't invest in anything if all the risks aren't explained properly. So if you found this episode helpful and want to continue learning and staying updated on all things real estate, we invite you to follow us on your favorite podcast platform. By subscribing to our show, you'll never miss an episode packed with valuable insights, expert interviews, and practical tips to guide you through your real estate journey. Also, I love hearing from our listeners. If you have any questions, comments, topic suggestions, or real estate stories to share, please reach out to us. You can follow me on my social media pages. Just search for Long's Real Estate, local realtor in Las Vegas and Henderson, Nevada. I will also save the links in the description of this video. Until then, remember, in Las Vegas and Henderson, the odds are always in your favor when you have the right real estate agent by your side. Thank you for joining us today. See you next week.